The Swiss finance minister resumed the acquisition of Credit Suisse without the merger. Credit Suisse would not survive Monday. Why did Swiss regulators take action against Credit Suisse, hereinafter referred to as Credit Suisse, before the 20th? In the latest interview, Swiss Finance Minister Karen Keller-Sutter said that if nothing is done, Credit Suisse will not survive Monday 20th. Doing nothing is not an option. She said that disorderly bankruptcy could mean a global financial crisis. The Swiss government was forced to step in to save Credit Suisse, which was already in trouble and could not survive another day of trading amid a crisis of investor confidence. However, UBS's government-brokered takeover of Credit Suisse has been widely criticized as a rough treatment of investors' rights, particularly the $17 billion worth of additional Tier 1 capital bonds at 1R deducted. A poll released on the 24th local time showed that 3/4 of the interviewed Swiss supported legislation to split up the new entity after the merger of Credit Suisse and UBS, and most of them were seriously worried about the government overreaching their powers. Other options are worse. Keller-Sutter was the trader behind UBS' acquisition of Credit Suisse. During the days of the crisis, she coordinated the matter on behalf of the Swiss Federal Council, together with the SNB and the Swiss Financial Market Supervisory Authority FINMA. At present, there are concerns in Switzerland that this government-driven acquisition will impose a huge burden on Swiss taxpayers, and the acquisition itself is not compliant. Keller-Sutter, who chose to speak out, disagreed, saying the other options were worse. If there is no solution, Credit Suisse's payment transactions will be severely disrupted and may even collapse. Keller-Sutter explained, citing expert estimates, that the impact of disorderly bankruptcy could be as high as twice the Swiss economic output. More broadly, we should have expected a global financial crisis, because the collapse of Credit Suisse would send other banks into the abyss. At the same time, the possibility of an orderly liquidation was also ruled out, as not only would the losses be considerable, but Switzerland would be the first country to liquidate a globally systemically important bank. Now is clearly not the time to experiment. Keller-Sutter said she did not see the sale as a bailout, saying no money has flowed from the Swiss federal government to the banks, but acknowledged that the deposit guarantee amounted to an insurance policy, making it indirect state support. Keller-Sutter also dismissed claims that the U.S. was pressuring Switzerland to save Credit Suisse, saying the U.S. Treasury Secretary didn't say to her on the phone that something like, "You have to make sure UBS buys Credit Suisse." It is clear to those inside Switzerland that a restructuring or liquidation of Credit Suisse would trigger major international turmoil in financial markets. She also said that the global regulatory regime for too big to fail banks established after the 2008 crisis is not working. That is, capital buffers and additional risk regulation rules are useful to tide over stressful times, but in a real crisis, promoting a plan for an orderly rescue or the failure of a big bank is not enough. Personally, I've come to the conclusion, she explained, that a globally active, systemically important bank cannot simply be wound up under a too-big-to-fail scheme, which legally is possible in practice. However, the economic damage would be considerable. She also said that just 3 months ago, she had asked, when will it reach the point where it must intervene? When will FINMA conclude that Credit Suisse is no longer viable? On the 23rd, FINMA issued a statement on the basis for its full write-down of at-one bonds issued by Credit Suisse, stating that due to the large number of inquiries about Credit Suisse's capital instruments, so-called at-one bonds, FINMA provided the basis for writing down these instruments. FINMA has directed Credit Suisse to write down its at-one instrument fully and notify relevant bondholders immediately. Secondary bonds are not written down. Questions about individual bonds should be directed to the issuer of the capital instrument. FINMA explains that it is based on the Credit Suisse bond offering prospectus and the Swiss Federal Council's emergency decree on additional liquidity assistance loans and federal default guarantees for liquidity assistance loans by the Swiss National Bank to systemically important banks hereinafter referred to as the emergency decree. Antonio Fada S., a professor of economics at INS and a researcher at the Center for Economic and Policy Research CEPR, said in an interview with a reporter from China Business News that after learning the lessons of 2008, European and American governments will always emphasize, "I will never bail out the market." But when they have to, they will. After 2008, regulation in Europe has been significantly strengthened. European banks are now much more regulated than they were before 2008. If European banks' balance sheets were in a very bad state, the central bank would have done it 2 years ago. 1 year ago or 2 years ago, it was discovered 6 months ago. Fada S. said the Swiss Federal Council may face a political storm. The final plan for Credit Suisse to be taken over by UBS has been strongly criticized in Switzerland. In addition to being dissatisfied with the above-mentioned FINMA decision to write down the one bond, but for Credit Suisse to retain some rights and interests for equity holders. The Swiss government is also responsible for this. Measures such as guarantees of 9 billion Swiss francs on the deal, and commitments to the central bank's liquidity support of up to 259 billion Swiss francs. Also drew dissatisfaction. The amount of support, equivalent to a third of Switzerland's gross domestic product (GDP), has sparked widespread concern among the country's 3 major political parties. Even the pro-business conservative Liberal Democratic Party, the third largest party, has called for Credit Suisse's domestic lender to be split from UBS once the merger is complete and markets calm down. A poll released by GFSBERN, Switzerland's largest polling agency, on the 24th showed that more than 3/4 of Swiss voters want to spin off the large banks after the merger of UBS and Credit Suisse. 83% of voters strongly agreed that Credit Suisse's management should take responsibility, and 71% strongly agreed that profits should not be kept private when taxpayer funds are involved. 47% of respondents strongly agreed with the statement UBS is too big now, it should be broken up because of the risks, while 32% said they agreed with the statement. Similar findings also suggested that investment banking should be permanently separated from deposit taking, with 47% strongly agreeing to introduce new laws to do so, and 31% agreeing. Most respondents also believed that the Swiss government had crossed the line in using emergency powers to liquidate some bondholders. At present, the latest news shows that the Swiss Parliament, which only meets once every few months, is scheduled to hold an emergency session in April. The Swiss Federal Council may then face a political storm. Another over half of respondents, 50%, said they would hold a referendum on the government's state of emergency decree. In Switzerland, only 100,000 signatures are needed to trigger a national referendum, the result of which will be constitutionally binding.